To really get some life into the juniors that are looking for gold, we need to see a real price increase. And right now there's this battle in the market. Is $2,000 going to remain the ceiling for gold, that it sort of tries to bump through and then always fails and goes back to 1,700? Or is it going to become the base from which it can launch to $2,000? And I think we are at the cusp of this or happening, where we will see a real price increase into the $2,500 to $3,000 level. That's real, not just tracking inflation. And this assumes like inflation manages to stay 5% or something like that.
In a changing economy, gold and silver could become more valuable assets. A renowned analyst, Kaiser, believes that the ongoing power struggle between the United States and China, geopolitical instability, inflation, and demand from emerging markets could all contribute to increased demand for gold and silver. As a result, he expects the price of gold and silver to continue to rise in the years to come. During a recent interview with Soar Financially, Kaiser highlighted that the price of gold has been increasing even though the amount of gold held by the GLD, a gold exchange traded fund, has remained mostly unchanged. This indicates that there are new types of buyers entering the market. Kaiser believes that the reasons for the rising demand and price of gold are already in place, but they have yet to be widely recognized. He believes that this upward trend in gold prices will continue, outpacing the growth in operating and capital expenses. According to Kaiser, the United States holds a dominant position in the global economy due to the US dollar's status as the primary reserve currency. However, finding a direct replacement for the dollar is challenging due to its extensive integration with global economic processes. Kaiser acknowledges a growing sentiment among other nations to reduce reliance on the US dollar. He warns of a potentially fragmented global economy if a divide between the Western and Eastern hemispheres deepens, leading to the diminished significance of the US dollar. Kaiser expresses concerns about a US debt ceiling crisis and escalating tensions within the country, which could potentially result in a significant crash or even the breakup of the United States. Such scenarios could significantly impact the price of gold. For instance, if the dollar loses its reserve currency status, its value may decline, making gold more appealing as a stable store of value. We will now bring you clips from Kaiser's interview with Soar Financially. But wait, there's more. To stay updated with all our future uploads, make sure to hit that subscribe button and turn on post notifications. Thank you, and enjoy the video.
I think whether or not a default happens, I think the desire is there to transition away from relying on the US dollar, but it cannot happen overnight. This is why I think gold, after waiting 30 years for it to really start increasing real price. I mean, do you realize that you take $400 gold in 1980 and inflation adjusted by the US CPI, you end up with about $1,521, where it's kind of kept track with inflation. But the reason nobody's excited with gold at $1,900, $2,000 is because the costs of mining gold have gone up, and we've doubled the above ground stock of gold since 1980 as a result of those initial increases. So the low-hanging fruit, the better grade stuff or the lower grade stuff that was near surface, it has largely been exploited. Get inflation. Real price comes from increased demand. What would cause increased demand for gold beyond trying to just track inflation? And that's why I think this power struggle between the United States and China for domination of the global economy, this is going to stimulate as a transition real new demand. And what's interesting is in the past year, I watched the GLD gold going in and out. It has largely been flat in terms of how many ounces it holds, and yet we've seen gold rising. That means there's a different type of buyer in the market for gold. And central banks have been described as accumulating a lot more gold in the past. But when you look at the net numbers, last year was actually one of the lower years where the increase in official holdings increase. It was actually much lower than prior years. From 2008 on, it's been steady, whereas before that, everybody was liquidating their central bank holdings. But the reason that this is not a correct description of what's going on is that some of these distressed autocracies, I think such as Venezuela and Iran, have been selling gold because they've got such brutal sanctions. sanctions against them. But other ones, and I think these are the ones that are in the sort of global south, they have been buying gold, but that has been masked by this stress selling, which is not going to last forever because they'll eventually run out of gold to sell. But the desire to convert, say, U.S. Treasury instruments into gold, that is going to keep increasing. And I think it's the optics for the retail market and the institutional market. They want to see this uptrend. The reason for why it should continue is already in place, but it's not really believed. And I think we will see this happen. And that's where you will see the price of gold outstrip the increase in the OPEX and CAPEX.
Moving forward, Kaiser also believes that the mining sector frequently faces challenges related to rising operating costs and capital expenses. He asserts that inflation exerts a greater influence on these expenses than the gains seen in gold prices. Kaiser initially presumed that countries such as Chile, Bolivia, and Argentina would supply sufficient lithium to satisfy the demand for electric vehicle batteries. However, he later discovered that the demand for copper, often referred to as red gold, is projected to experience a significant surge. Additionally, Kaiser refers to lithium as white gold and emphasizes the substantial growth in demand for this resource, estimating a 600% increase by 2030. Let's get back to the interview.
And one reason the mining sector suffers is that when we see these general inflation numbers, it's always worse for operating costs and CapEx. That always is more. That's why every time we're waiting for the next feasibility study update or so, we're expecting escalation of capital cost and operating cost assumptions that swallow up whatever gain gold has accomplished. I hadn't really done my homework on the future demand or where this could come from. I assume that the Chileans and the others, like maybe even Bolivia with its huge resources, and Argentina, they would mobilize all the lithium that the world would ever need to fit, complete replacement of ICE cars with lithium-ion battery motors. And it wasn't until early last year that I understood that something had changed. And I started reading these government reports like from the International Energy Agency. And they're actually just related to EV expectations for 2030 to meet their net zero emissions goals by 2050. They're talking copper needs to increase 50% by 2030. This is above and beyond the macroeconomic growth. This is why, I'm calling copper now red gold. There's yellow gold I'm bullish on. There's red gold, and lithium is the white gold. But they were saying it's they need 600% more. And so I did the numbers, and I follow what the USGS publishes. And in 2021, it was 100,000 tons of lithium metal equivalent. Last year, it was 130,000 tons. And when I do the math, we're talking, and assume that $10 a pound is what you're going to need to make this happen, because you get too cheap, it just isn't going to happen. We're talking about this market that used to be $200 million becoming worth $100 to $200 billion by 2030. That puts it in the league of copper and gold, puts it above, beyond zinc and nickel. It's incredible. And where's half of it's going to come from Australia, the pegmatites there. They still got lots more to find and develop. And also the brines. They're going to get their act together and mobilize a lot. And then there's the direct lithium extraction from the oil field brines, which are still kind of a wild card. It's a technological question. It could provide an awful lot, though we don't know at what price. But the other half has to come from pegmatite deposits. And that's where Canada, they found countless pegmatites while looking for gold and base metals through the past many decades of exploration, and they would note it.
The Federal Reserve's decision to hold the benchmark rate unchanged at 5% to 5.25% is likely to have a mixed impact on the gold market. The decision could lead to increased market uncertainty and volatility, which could drive investors to seek safe haven assets like gold. On the other hand, the decision could also lead to a decline in the value of the US dollar, which could make gold less attractive to investors. As a result, gold prices could be volatile in the near term, but they are likely to remain range-bound in the long term. What do you think about the interview with John Kaiser? Do you agree with his predictions about the future of gold and silver prices? Please share your comments and observations in the comments section below. If you found this video informative, remember to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.